I am really excited to introduce our next session. We are so honored to have Don Wilson with us today for our keynote. Don is founder and CEO of DRW, a diversified trading firm that is becoming a significant player across the various financial markets. His visionary leadership led to the launch of Cumberland, DRW's digital asset arm, back in 2014, making them one of the earliest institutional players in the space. Please join me in welcoming Don Wilson for a fireside chat led by our very own Josh Frank.
Hey everyone. So first of all, huge thank you, Don, for coming and doing this. I know you don't do this often, so we appreciate having you here. And so let's get right into it. So you're an OG in crypto. For many people who don't know, DRW has been in crypto for I think about 10 years or more at this point. And you had previously a strong legacy in TradFi markets. Don is known as a titan of trading among many. And so today, a lot of the folks in the audience here are, at traditional hedge funds. Many of them still aren't even trading spot crypto. Some of them are trading CME. Some of them are trading the ETF. You got into the space. You got comfortable with it over 10 years ago. So why did you get into crypto initially? And, do you think the move has paid off the way that you expected it to when you first entered the space?
Yeah. So first of all, Josh, it's great to be here. This looks like just a great event that you've put together. So congratulations. Yeah. So back in 2013, there were a number of people at DRW who were very excited about Bitcoin, and we spent a lot of time talking about, is this interesting? Why is it interesting?
Turning our attention to kind of the intersection of, TradFi and crypto, which is where DRW really operates. One of the things that you said up front, when you talked about crypto, was that you're excited about it, from a technology perspective, from a blockchain technology perspective as well. And so can you talk about why you found that exciting?
Yeah. So in traditional financial markets, one of the things that creates systemic risk is uncollateralized, under-collateralized, or improperly margined, improperly managed markets and venues. And so how do you improve that? Well, you improve collateral mobility. And so if you can move, cash or treasuries or other forms of collateral 24/7 instantaneously, it opens up all sorts of new improved ways of margining things and managing the whole financial ecosystem.
And so one of the things that, kind of came out of DRW early on was digital asset. And so can you kind of talk a little bit about digital asset and why digital asset was started, what kind of the gap was that existed in the market and what needs it fills?
Yeah, so as I said, when we were kind of debating this back in 2013, we said, yeah, it all matters. It's Bitcoin's relevant, public cryptocurrencies are relevant, and yes, the blockchain technology for facilitating collateral movement and value movement in traditional finance is also relevant. All these things are important, and so in addition to starting Cumberland, we also were part of the creation of digital asset with that goal in mind of how do you build a chain that can support the traditional financial system, traditional financial markets,
And so, yeah, maybe kind of talk about what digital asset is and, what you're kind of excited about right now. And I would say also the traction that you've seen over the last 10 years.
Yeah. So I mean, 10 years is a long time to do anything, um, and a lot of people lose patience. But it turns out that this is actually a hard problem to solve. Um, and so what Digital Asset did was they built a blockchain called Canton, um, and Canton is focused on the combination of configurable privacy along with composability. So, um, configurable privacy, meaning in traditional finance, people generally don't want to broadcast to the whole world what equities they're buying or selling, or even, uh, you know, where they're posting variation margin. Because if you can see where somebody's receiving variation margin, sending variation margin, you can reverse engineer what risks they're carrying. And that has, that level of transparency is not something that anybody in markets really wants. Now, it's interesting in the crypto space, people have kind of gotten used to it and they're like, oh, that's the ethos of crypto. It's all public and whatever. And that's great. I mean, I have a lot of um, I find the crypto space super fascinating, but that's not going to work for traditional financial instruments. And um, and then composability is the ability to move to transact between different uh, different instruments that both have different forms of privacy, but at the same time, you can do so in in a decentralized, risk-free manner, atomic manner. And so it's that combination of things that actually, if you build a blockchain and you don't think about those things from the ground up, it's probably impossible to wind up with a blockchain that actually facilitates both of those things in the way that traditional financial markets need. So that's that's what the team set out to do. As I said, it took a long time. Last June, or this whatever it was, a handful of months ago, um, the public Canton blockchain network was launched. That's a decentralized network, and yeah, so they're kind of off to the races, and there are a lot of different traditional market participants that are doing stuff on top of it.
And so, you kind of spoke about, crypto ecosystems and TradFi ecosystems. So, how do you see these? And I think you kind of alluded to it in talking about, the fact that, there's reasons why you would want to shield transactions, why you would want privacy and things like that, which, there's benefits of using crypto rails and doing things in more of a traditional way. But kind of how do you see those two ecosystems converging going forward?
Yeah, so one example of convergence that is, kind of coming up now, that I'm super excited about is intraday repo. So let me talk specifically about what I mean by that. So right now, as many of you probably know, if the rails, the connectivity between the banking system and the DeFi system is a little bit tenuous. And if you want to, let's say that you're anticipating a busy weekend in crypto, and so you want to make sure that you have sufficient stable coins ready to deploy into different exchanges because you're expecting, trading opportunities to come up. Well, that means that you're going to forgo yield for the weekend on that money. That's not ideal, especially in a 5% risk-free world. So there's a real cost to it. Now, if instead you could take fully paid for tokenized treasuries that are, like in our case, we have lots of strategies that involve treasury trading and treasury relative value trading, et cetera, et cetera. And most of the treasuries are repoed, but some of them are fully paid for. So if we can, on a Sunday morning, say, oh, we need another $50 million in the crypto ecosystem. We want to take some of our fully paid for treasuries, repo them out, and exchange them for a stable coin, then that's a super useful thing to be able to do.
And so, you talked about 24/7 kind of collateral mobility, but what about 24/7 trading, which is, kind of a conversation that's starting to happen. What are your thoughts on, whether or not you think all markets will eventually be 24/7 and whether or not there's value there?
Yeah. So just to expand on that collateral, on
Yeah,
that
please.
intraday repo, there are some of the participants in the Canton ecosystem are already, this is already their core business. So Broadridge is an important Canton participant. They do, they have this DLR product on top of Canton, where they're, doing repo for large amounts of treasuries. TradeWeb is another, Canton ecosystem participant, and they're in the business of providing a venue to transact. So, does that mean that there becomes a TradeWeb intraday repo ecosystem? Yeah, I mean that would make a lot of sense. And then that translation into stable coins like USDC, it all kind of fits together. Now, to your question of do all markets become 24/7? That's that's a discussion that's starting to take place, and we've CME has said that they intend to move some markets to 24/7. It's interesting. We had a internal discussion about how would we feel about all CME markets becoming 24/7, and especially the teams that provide liquidity in the kind of institutional markets, things like SOFR options and crude oil options. They were like, oh my God, like that's gonna ruin our lives. Can we please have the weekend off? And I think for those markets, it may not be all that useful to have them be 24/7. On the other hand, for markets that are heavily retail dominated, that 24/7 framework may be useful, and I think CME's intention is to start off with crypto futures. That makes a lot of sense. We already know, the crypto markets are 24/7, so that seems like a logical place to start. And then where do they go from there? My thought is they should focus on markets that are primarily retail driven. But once that happens, that's a perfect example of that additional convergence between the crypto space and the traditional market space, because okay, now you have 24/7 markets cleared at the CME clearinghouse. Well, probably time to think about 24/7 collateral mobility. And then you look at this intraday repo system that right now is very useful for the crypto ecosystem, and all of a sudden you plug it in and you say, wow, that can fuel the 24/7 markets on top of the traditional exchanges. That's super cool.
And so, you guys have been around in crypto for over 10 years. If we hosted this conference 2 years ago, I would imagine that a bunch of the folks in the room blew up. And so you guys have managed to have, I would say very strong risk management. So how do you think about risk management in crypto. I'm curious actually how you originally thought about risk management in crypto, because now you have all of these custodians, you have much better counterparties, you have KYC, there are safer ways to store crypto, there are safer ways to transact. When you first started, there was pretty much nothing. And so how did you get comfortable with, risk associated with digital assets 10 plus years ago, and how has that evolved today, to kind of fit your needs?
Yeah. I always say it's good to be a little bit paranoid, and I tend to be a little bit paranoid. And so, these early crypto exchanges. Exchange is being kind, right? They're not really exchanges. They were, venues for transacting, and um, so I was constantly pushing the team from very early on about, hey, if you have assets on one of these platforms, there's at least a 25% probability that they're going to blow up in any given calendar year. And so if you're not generating, if you're generating a 35% return on keeping those assets on that platform, that doesn't cut it. Like, you're not meeting the hurdle. And so just enforcing that kind of very thoughtful paranoia about counterparty risk was something that I was insistent on from the very beginning, and I think that saved us lots of heartache over the years.
And so, as kind of evidenced by crypto, but other markets as well, DRW has constantly been an innovator. And so, what do you think is next? It doesn't need to be crypto, but what's kind of the next it market or it thing that you guys are looking out for?
Yeah, one of the things that we're working on is thinking about the market for compute. And so, my thesis is that as demand for, AI generated output grows, the demand for GPU compute is going to continue to accelerate. I think it's actually plausible that in the next 10 years, the world will spend more on GPUs than on crude oil. And so I would argue that makes compute the largest commodity in the world. Right now, obviously, there are no risk management tools for it. There's no centralized marketplace for it. And so that's something that we're working on. I'm super excited about, actually both legs of that. A spot market for compute, and then also risk management tools that come out of that.
And I guess, one kind of final question here, which would be, and I think you kind of hit on it with the election, but really going into, next year, kind of what are your expectations for the digital asset market and markets broadly?
Yeah, this election outcome has important consequences. I think that I think it's going to be a very constructive environment for the entire digital asset space. I wouldn't be at all surprised if there's some kind of U.S. Bitcoin reserve that's set up. If that happens, obviously, I think you have to be a little
In case
bit.
the U.S. government is listening and wants to buy Bitcoin, you can give Don a call, I'm sure.
You just have to be open-minded to what the right side of the distribution looks like for Bitcoin, and I think for the whole ecosystem.
And then what about traditional markets?
Yeah, I think that that you're seeing the Trump trade in full force with the significant increase in U.S. yields. And by the way, increasingly and interestingly, and this is kind of was my expectation, but a decline in European yields. I think that it's almost a 30 basis point swing in spread between the 1 year out, European short rates and U.S. short rates just this morning since this election, and of course the big rally in equities. So all of that and stronger dollar, all of that makes a ton of sense. It's kind of, I think, a reasonable reasonable interpretation of the implications of the election.
Awesome. Well, thank you so much. I appreciate it. Thanks everyone for listening.
Thank you.